When people think about the finance world, they typically think about the money that you can make. However, it is very important to think about the money that you can lose. Today, I will be talking about the financial crisis of 2007 and 2008. According to Heather Stewart, this crisis is the worst financial crisis since the Great Depression in 1929. Understanding this crisis helps you to become more financially prepared. In order to fully understand the 2007-2008 financial crisis, you must first gain understanding on what led the crisis to happen, what happened during the crisis, and what were the repercussions of the crisis after. So, what led the 2007-2008 financial crisis to happen? First, the Federal Reserve reduced the federal fund rates. Brian Duggan stated in his report of the crisis that the federal fund rates were reduced 7 times over the period of May of 2000 and December of 2001, dropping the rate from 6.5% to 1.75%. This led to consumers to take advantage of the cheap credit to purchase all kinds of goods, but especially houses. Secondly, banking laws in 1980 were changed in subprime lending. Banks were now able to offer mortgage loans that were structured in balloon payments, which were large payments paid at the end of the period, or just the typical adjustable interest rate, which were the annual interest expenses. If home prices increased, borrowers could protect themselves from the payments. If borrowers couldn't pay the mortgage, then banks could now repossess the land and sell it for more. This is when subprime lending became a very lucrative investment for banks, because banks would target people often with poor credit and very low assets so that they can maximize their profits. This leads me to my second point of what really happened in the financial crisis. One of the main events of the financial crisis was the rising of the federal fund rates once again. So previously I talked about how the federal fund rates dropped. Now they were rising back up. Forbes advisor Taylor Tepper recorded the federal funds rate raised from 1.25% to 5.25%. People started struggling to pay their loans because of the increased rate. The value of homes drastically dropped because of the market was very slim and people were struggling to pay off their own mortgage, so they couldn't get in the housing market for new houses. Banks started to lose value on mortgages because people weren't able to pay it and they had to lower their mortgage rate and expenses, and which led to a lot of problems with their portfolios and all their banks, not only in the U.S. but in global market as well. The second major problem that occurred during this time was the decline in the value of mortgage securities. Mortgage securities were on the decline. It caused major losses for banks, hedge funds, and mortgage lenders. Some major firms had to liquidate their hedge funds to ask for governmental loans to pay it off or file for bankruptcy, while other large firms just lost billions of dollars. These events dramatically impacted the financial world and left the world in complete disarray. This leads us to think, what was the aftermath of this crisis? There were lower gross domestic product rate and employment rates after. A study in 2018 by the Federal Reserve Bank of San Francisco found that 10 years after the start of the financial crisis, the country's gross domestic product rate was down 7% lower than what it should have been if the crisis did not happen. Simply put, this just represents like a $70,000 decrease in lifetime income for every single American. Approximately 7.5 million jobs were also lost during the crisis, which is a double of the employment rate before the crisis. And even with the economy slowly adding jobs back, many of the jobs were very lower paying, so they weren't really replacing the jobs of those who lost their jobs that were higher paying jobs. Edward J. Scone's article on the erosion of ethics expressed that bankers who helped create the crisis faced very minimal judgment. Some bankers lost their jobs because of their mismanagement and misorganization, and others who had resigned often did so with very large bonuses. No CEO or senior executive was sent to jail or even prosecuted in court for their actions in this financial crisis. So in conclusion, the financial crisis of 2007 to 2008 had an astounding impact on the financial lives of millions all over the world. In order to truly grasp this historical event, we have to look at the multiple angles to learning about what led up to the crisis, what happened during the crisis, and what were the repercussions of the crisis after. The 2007 to 2008 financial crisis taught the world the importance of accountability. According to George P. Schultz's article on lessons learned, on the financial crisis, any system without accountability will eventually falter, as we have seen with this financial crisis in particular. That is why we need to be sure to hold all institutions accountable, including the governmental institutions. Understanding this crisis is very important because of the uncertainty of when another financial crisis could appear. Because of this, you have to be financially sound and prepared for events like this so that you don't become a victim of the next financial crisis. Thank you.